Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023, October-November, Paper 3-3, question number 3. This is a structured paper 3 which consists of 3 questions. Each of them will be of 25 marks and the total time limit given for this paper is 1 hour and 30 minutes, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve question number 3 under 30 minutes. So without any further delay, let's get started. HT Limited is a retail business which makes all its sales and purchases on credit terms. Okay, it provided the following information taken from its forecast financial statements for the year ending 31st December 2024. So we have information regarding opening inventory. We have information for revenue and purchases, and both of these will be on credit terms. And at the closing date, we have our inventory, trade receivables, and trade payables. Let's have a look at our first question. We need to explain what is measured by the working capital cycle. The formula is not required. Okay, so we just have to define what is meant by the working capital cycle. So it is just a measure of solvency of the business, and this incorporates how long does the business takes to turn the net current assets into cash. And in this case, the net current assets involved will be our inventory, trade receivables, and the trade payables. Let's write it down. So it measures the time it takes a business to turn the net current assets into cash. And this is because this incorporates the inventory turnover, which basically calculates the time it takes the business to sell those inventories and convert it into cash. It also incorporates the trade receivables, which is the time required by the business to receive money from credit customers. And then it also incorporates the trade payables, which is the time required by the business to pay back to the credit suppliers. Okay, into cash, and measures the solvency of a business. That's all. Now we need to explain why a retail business is likely to have a shorter working capital cycle than a manufacturing business. So again, this is just the time required by the business to turn the net current assets into cash, right? And the difference between the retail business and manufacturing business is that manufacturing business, the cycle will start with the purchase of raw materials, and it will also incorporate the time it takes for those raw materials to be converted into the final goods and finally be sold to the customers. But in case of retail business, there will be no production, right? So there is no time required before the goods are ready to be sold, because we already purchased the goods that are ready to be sold to resale it again for retail business. That's the reason behind this. Let's write it down. In a manufacturing business, the cycle will start with the purchase of raw materials, and in a retail business, no production time is needed before goods are ready to be sold. That's all for the first part. Let's move towards the second part. We now need to calculate the working capital cycle for TH Limited using the forecast information. We need to assume a year of 365 days. Okay, so our working capital cycle the formula for this is just going to be the inventory turnover days plus the trade receivables turnover minus the trade payables turnover. Okay, we first need to figure out these 3 turnover days. So let's start with inventory turnover days. And remember, the formula is just going to be the average inventory divided by the cost of sales multiplied by the days, which is 365. Let's have a look above. So average inventory is just going to be opening inventory plus closing inventory divided by 2. In this case, the opening inventory is 15,092. Closing inventory is 19,278 divided by 2. This results in the value of 17,185. Now we also need the cost of sales, which is the opening inventory plus purchases minus the closing inventory. So the opening inventory in this case is 15,092. The purchases is of 161,000. And the closing inventory is 192,078, which results in the value of 156,814. Let's write down these values. So we calculated our average inventory to be of 17,185. Our cost of sales was of 156,814 times 365. This results in 39.999, and we need to round it off, so that's just going to be 40 days. Now we repeat the same process for trade receivables turnover. Remember, the formula is just going to be trade receivable divided by our credit sales multiplied by 365. And the values are given clearly. So our trade receivables is 24,164 and our revenue is 210,000. Let's write it down. So 24,164 divided by 210,000 multiplied by 365. This results in 41.999. Again, we need to round it off, so that will be 42 days. Now we need to repeat the same process for trade payables turnover. The formula is similar, so that's trade payables divided by the credit purchases multiplied by 365. The values are given above. So for trade payables, we have 19,408 and the purchases is of 161,000. So 19,408 divided by 161,000 times 365, which results in 43.999. Again, we need to round it off, so that will be 44 days. Now let's calculate our working capital cycle. Inventory turnover is 40 plus the trade receivables turnover is 42 minus the trade payables turnover is 44. This results in the working capital cycle of 38 days. That's the second part. Now we need to calculate to one decimal place the net working assets to revenue using the forecasted information. Use the closing inventory value. Okay, so the formula is pretty simple. We just divide the net working assets by our revenue. And for our working assets, that's the net working assets, right? So it's just going to be inventory plus trade receivables minus trade payables. So 19,278 plus 24,164 minus 19,408, which results in 24,034. Then we need to divide it by the revenue of 210,000 multiplied by 100%. So that's 24,034 divided by 210,000 multiplied by 100%, and this is to one decimal place. So the value is going to be 11.4%. That's all for the third part. Now we have additional information. The directors are concerned that the working capital cycle is too long. They believe that if they improve the credit control procedures of the business immediately, then the value of trade receivables on 31st December 2024 could be considerably lower than in the forecast information and sales would be unaffected. We now need to calculate the reduction in the value of trade receivables on 31st December 2024, which would cause the working capital cycle to fall by 8 days. Okay. So if our working capital cycle should fall by 8 days only due to the change in trade receivables turnover, then we are just assuming that the trade receivables turnover will now be lower by 8 days, right? So in this case, the required trade receivables turnover is going to be the previous turnover of 42 minus 8 days, which results in 34 days. Now we need to figure out the value of trade receivables which will satisfy this equation. So trade receivables, and we are told that sales would be unaffected. So we can just include the previous sales, which was of 210,000. We multiply it by 365. This should be equal to 34. So the required trade receivables is just going to be 34 times 210,000 divided by 365. And this results in the value of 19,561.64. We can round it off as 19,562. And we are asked to figure out the reduction in the value of trade receivables. So reduction is just going to be the previous value of trade receivables given in the question, and that was of 24,164 minus the new value. So 24,164 minus the new value of 19,562, this results in the reduction of 4,602. That's all for the fourth part. Now we need to explain how this reduction would affect the net working assets to revenue ratio. No calculations are required. So in this case, our value of net receivables is decreasing, right? And our net working assets is just the inventory plus trade receivables minus the trade payables. And the total ratio is net working assets divided by revenue. Our revenue does not change, so the only change will be in our net working assets, and our trade receivables is now decreasing, which means that overall the net working assets will also decrease. And if the value in the numerator is decreasing, the overall ratio will also decrease. So that's our conclusion. Let's write it down. The ratio would become lower because the net working assets of the business would be reduced. Okay, that's all for the fifth part. Now the directors want to reduce the working capital cycle and the net working assets to revenue ratio each for the several years to come. So we are trying to reduce the working capital cycle. If we're trying to reduce the working capital cycle, okay, the formula is just inventory turnover plus trade receivables turnover minus trade payables turnover. So in this case, we require a reduction. So the positive values such as inventories as well as the trade receivables should decrease, and the trade payables turnover should increase, right? And for the net working assets, again, it's the same thing because we require the inventory to be lower, trade receivables to be lower, and the trade payables to be higher. So it's just going to be the same thing. Now we need to advise the directors whether or not they should try to reduce these ratios each year. We need to justify our answer. Okay. Now remember that reducing our working capital cycle means that the company is very efficient in turning its inventory and trade receivables as well as trade payables into cash. So that's just turning of net working assets to cash in a short amount of period, which means that our company would be classified as efficient. But again, the decrement in the net working assets to revenue ratio will result in an increase in risk, because in this case we require our assets to be decreasing and the liabilities to be increasing, which should not be the case because we should have sufficient assets to cover our liabilities, right? So that's the opposite of what we want, which means that there will be an increase in risk. Let's write it down. A fall in the ratios indicate an increase in efficiency but an increase in risk as well. Okay, this is a 5 marks. That's the increase in efficiency and increase in risk. That's 2 points. Now we require 2 more points and then a final decision. So the good thing here is that if we decrease the working capital cycle, it means that the resources are tied up for a less amount of time without earning a return. Let's write it down. If the working capital cycle is reduced, then the resources are tied up without earning a return for a less time. And let's say the working capital cycle was not reduced, but if the same amount of working capital can generate more sales, then it just means that our net working assets to revenue ratio will now decrease, which is what we want, right? Because net working assets, if it's not changing and it can increase the sales revenue, then as a whole this ratio will decrease, right? So which means that our resources are being used more efficiently. If the working capital cycle can generate more revenue without changing, without any change, then the resources are used more efficiently. Now, based on these factors, we need to make a decision. So personally, I would want to focus on the increment of trade payables, right? So if we increase the trade payables, then it might damage the relationships with suppliers. So it might be difficult for the company to source their materials in the future, due to which I'm going to advise against reducing these ratios. Let's write it down. The directors should not try to reduce these ratios, as the increase in trade payables could damage relationships with suppliers. Alright, that's all for the third question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.